Welcome back to Money Discourse. We have been inundated with at least one person asking, where have we been? Well, we've been away on a world tour, fully paid for by Rajan's gains last year. So thank you very much. Today, we're going to be talking about inflation, rate cuts, the Mag 6. Yep, that's right, not 7, because Tesla has been a dog recently. Also, the EV market, China, and the Money Discourse portfolio. Rajan, why don't you take it away?
Yes, I mean, if you look at how we ended last year, it's been it was quite the rally. And to be honest, a picture says 1,000 words. So if we look at the S&P and what it did basically since last year, so just before the end of November, we were trading at just around 4,100. And if we go back towards the beginning of the year, we were sub 4,000. And since November, pretty much in the space of 2 months, we just rallied a good, to a high, almost 700 S&P points, which is just wild. And NASDAQ was even more, given its concentration of those tech names. So it was one hell of a wild rally. So pretty much anyone's portfolio, everyone at this last 2 months of the year, all of a sudden became great traders, because all of a sudden all their stocks are going up and they're going, the amount of headlines they got. Cathie Wood had her best a month since this time, and of course she did, because her portfolio was destroyed and all of the shit rallied, because a lot of crap is in my portfolio too, and so that rallied so much as well. So all of a sudden it's just these headlines which were really making me scratch my head. I'm digressing here, but it was just the way the media spin it. It's like, this is the best, this outperformance, but mate, you have to look over a certain time period. Everyone's going to outperform in 1 month, right? When you're down 60% on the year or whatever, So anyway, so we had some good rallies. A lot of Russell stocks, especially these small caps, were all going up. And against the catalyst was the Fed stance. And as always, as we know, the Fed really is the ones that dictate where the market is going. So as we sort of pretty much thought that 5.25%, 5.5% was going to be the top end of rates, there was no incremental benefit for raising it anymore. Like, I don't think they were going to go achieve anything else. And we're seeing inflation slow down. And again, I've said this before, it's the rate of change. So we're still at very high levels, but when inflation was soaring 8-9% last year, and now we're rising 1-2%, 3% on last year's 8-9%, we're moderating, but we're still, the prices are high. Food prices, especially in the grocery markets, are still high, but it is calming down, and that's the figures that everyone wants to see. And now everybody's counting in rate cuts. So my checks and balances looking out, we got from 1 or 2 rate cuts all the way to 6 rate cuts next year. Some of the analyst projections going all the way down to 6. I don't see that. I just see a couple, maximum 3, if that. I wouldn't even be surprised if they just did 1 token one. But it all really depends on what is going to happen this year. And there's a lot of people calling for a soft landing or some kind of recession, and it all plays out. But again, all the numbers seem to still, everywhere I look, and then, I know it's not representative of the whole of America, but things just seem strong. People are spending, so I don't know. So I mean, so if we look at the S&P chart, we're right here. I think that's near an all-time high again. And to be honest, I did not see that coming after the sideways year that we had for most of the year. But so I think it'll be much harder to push much higher on the back of that. But as you said, it's the Magnificent Six. Microsoft, now the new new highest market cap, overtaken Apple. Apple, although it did rise, its lack of AI headlines or AI, their lack of what they're showing, what they can do on the AI space, has left it a bit of a laggard. Whereas Meta, Microsoft, NVDA are just on another planet. NVIDIA just under 550. It's a 1.3 trillion market cap company now. Microsoft, like, pushing on 3 trillion. Meta, all-time highs. It was sub 100 last year, which is crazy. So, now we're at 360, 370 odds. So that's what's been pushing up this market. And this market is, like I've said to you quite a few times, it's becoming a very highly concentrated market, that these indices are hedged outright for these big, massive tech companies. And so it doesn't really matter what anyone else is doing. It's as long as you're Microsoft and all of these guys are all going up, the market's going to carry on going up. So that is your play. Do you think Microsoft's going to, is this AI, the massive premium built in for their Copilot and everything like that, is this going to translate to revenue, which can justify that valuation? That is the bet that everyone's going to be making going forward. So yeah, what's your take on that?
Yeah, like you said, it all depends. Does it translate into revenue, especially with the OpenAI and Azure deep integration valuations are like crazy high. I expect OpenAI's valuation to come down from the, circa 80-90 billion, coming down as, all of these other competitors are like getting AI models that are actually really good, at least comparable. So there's a lot of competition in the space. And then, you might have a model that is like X times better, but is it cheaper? That's the main thing, that if they can find a way to get these models like super, super cheap and just good enough to do most of these tasks, those are going to be the winners. But then again, it's just a race to the bottom in terms of pricing. So then really, where is the shareholder value going to be realized from that?
Yeah, no doubt. I mean, that's the thing. It's everything with this market, as we know, everything overshoots both ways. And the key is to identify where you think it's overshot, and everything goes on hype. But right now, these big caps, like you're saying, all this, they're getting so much flow into them every time. Everyone, when they think about where can I put my money where it's safe, it's always these mega cap tech. And at the end of the day, I just don't see enough selling pressure near term anyway. But the thing is that we've got to look out for the earnings. We've had some of the major banks that came out on Friday, and we're going to obviously start getting a lot of these come out over the next few weeks. And we're obviously going to see more commentary over their 2024 outlook. Now, the real question is, like with NVIDIA, obviously they're benefiting the most because they are selling a shit ton of hardware, but is how sustainable is this growth? And inevitably, just like inflation, where inflation can't sustain at 10% and it tapered off, I expect the same thing with NVIDIA. Like this growth is not sustainable, but the question is, can they maintain this level of sales? And I don't know, to be honest. We'll find out. But everything for them, all their guidance, they're undershooted by $1 billion, $2 billion. So they're going to obviously have another incredible quarter again. I mean, it looks like this market can't go down properly unless these big caps give it up, which at the moment it doesn't seem like they're doing, because every day when I see the market weak, it looks like it's weak, but then I look at the indices and it's all flat. And I'm like, why is it flat? It's because Amazon is up, Microsoft is up, Meta is up. And then when these guys are up, then the rest of it doesn't matter what everything else is doing. So it's, I mean, this is where it is. But like you was, so it's going to be, it's a tough one to call this year right now, but things will come clearer as we go along, especially through this Q4 earnings season.
So what's your take on the most recent CPI kind of putting a damper on the March rate cut chances? At one point the market was pricing in a 70% chance that they would start cutting in March.
I mean, do you know what it is that, considering how much has dropped from where it was, again, I think the comparison's now going to be much harder. And so when we were talking last year about how where oil price was, where nat gas was, and everything like that, we always sort of thought that, it's naturally going to go down. But if you look at it, I think this is where we're just going to stay now. I think it's going to be hard to get it down to 2% now when you look at it on a year-on-year basis, because you don't have that Russia war that we had last time. It really, really inflated a lot of the prices, which naturally was going to give you that big drop in price. But things had normalized somewhat last year. So to get it down to where it was, I think it's going to be much harder. But I don't think it's the right move to cut rates too much, because everyone is saying that this housing market, there is so much pent up demand based on just waiting for that little drop, and then everybody's going to go in, right? And one of my real estate friends were like, right now people aren't willing to give up a 3% mortgage for a 7%, but people will give up a 3% mortgage for a 5.5%. It's not so much of a differentiator. So you might see much more supply come on the market, but a lot more demand. So I reckon this housing, there's been such shortage of supply in housing that really could could really pressure CPI to the upside. But then if you look at oil prices, it's really being pressured. And, I was reading that the EV uptake is really affecting oil demand. And so now it's just not seeing that same demand as it was before, so also, that is,
we also saw things that kind of pushed up the CPI reading, like used cars, that had a bit of an effect on it. But the Mannheim index shows, like, for the last 3 months, it's been negative. So I'm not sure where they've got that data from, I'm sure they're going to revise it, at the next read and say, because sometimes the figures you're like, where are they getting this from?
Yeah.
Also, insurance rates, are like talking about like a 20% inflation currently, and the thing is that that's a lagging indicator, because within insurance, it's like healthcare costs and repair costs are going up. So, obviously insurance companies need to go ahead and actually ask the regulators if they can increase the price that much. And, the regulators can also take up to a year to approve that. So this is where, all of these things are like kind of coming out of the woodwork and causing these figures, which we like, because if you think about it, it's like the whole economy based on one number, right? Like literally, it's like you take such a complex, huge dynamic system and then you take it down to one number of CPI, it's this. And for that one number, we will decide everything else. Like, come on, like how, or what kind of unsophisticated world do we live in? It's just like,
and once that can be so fudged as well.
Yeah.
But the thing is that you saw the reaction. Like I think CPI now, of course, is still a widely watched thing, but given where it is now, like it's 3.4% the last reading, that it's not having those gigantic moves that it was happening for the last few months. So I think it's now, I think the market, or the way I see it anyways, it's now settled into this 3% range, and you might get a couple of bips above, below. It might creep into the, into the high twos. But I think if the Fed cuts rates too much, you're going to see that flying up, because not necessarily in oil and food and all of that, but just some of these other things. And like you said, in used cars, I just sold a used car. Hey, there's no freaking prices going up there, and then I just swapped it for another one. And car prices are, I mean, there's, especially with the EVs anyway, there's a lot of depression in these prices, and we've seen Tesla cutting price to China. They're just constantly cutting prices, and there's a lot of competition out there. Like, from what I'm hearing from, people, is that dealers, if you want to buy a car, the dealer will haggle. The dealer has got wiggle room to discount, whereas before they were like, oh, this is what it is, So there's definitely room there to cut prices.
100%. And the thing is, there is just a massive supply of EVs coming from China, kind of flooding in Europe. It would be even more in the States, but they have the tariffs that Trump enacted. Otherwise, I mean, the thing is that when you look at the Chinese EV market, I don't think they were looking to export all of these vehicles to like around the world. It was like, initially that capacity was for domestic production, but with the Chinese economy really not doing as well as they hope, got a huge amount of supply that they have to offload somewhere, and they're obviously getting all these government subsidies. So literally Europe cannot compete, because if you look at China, at one point it was a net importer of cars, right? I think they used to import almost like 90 million cars or something like that over a certain period of time, and now it's a net exporter of cars. So it's basically what it used to do with phones, or currently still does with everything else. Like, China's just up leveled, and now if you look at the quality of these vehicles, like, and if you just look at the price difference that you could get, like, and with all the technology and everything in there, it's like, wow, like, it looks like for the EV market.
We saw those when we went to Oktoberfest, and we saw some of them at the airport. I mean, they look, some of these cars, they're top notch. But you know what it is? So, talking about China, that has been, that's been the big, so US markets closed today, MLK Day, but Japan hit another all-time high. So you got the Japanese market all-time high. You got a lot of these other Asian markets at or near all-time highs, but then you got China, which is a dog, right? And then there's a lot of grappling. The whole narrative is just the economy is really stagnating, and it just can't catch a break. And so just based on my contrarian way I trade, is like, naturally you just think, China. It seems that if there's any bit of a tailwind or any good news or any type of momentum that goes, I feel like, your Alibaba, KWeb, FXI are ripe for, based on the current valuations, they just seem to be the best risk to reward. But you still have so much political turmoil. And then I was just thinking, we got JD below 25, which I'm long, not doing good. But then I was just thinking, okay, this is I mean, how much worse can it get? And you got Baidu is down 11%. It went down 11% over in Hong Kong today, because there's a report that its AI equivalent to Bard and ChatGPT is being used by the Chinese PLA. So now they denied this, but it doesn't matter. It's now going around in the market. Now there's this fears that the US are not going to sanction Baidu, like the chips and all of that out of China. And because of that, Baidu dropped 11%. So I'm just thinking to myself, thank God, first of all, I wasn't long it. Now I think it was at 104 or 105 last time I checked. It's going to be like, close to low 90s. Could be worth a play. But the thing is that everything in China is worth a play. So it's 109. So I mean, if it was down 11% in Hong Kong, you're looking at about 98. It's looking to open up tomorrow in the US, which is back below 100. But bear in mind, it was trading at 160, like literally just the end of August. And before that, we were 123, 150. So we're back below 100 again. Got to be worth something. So if I'm looking at something right now, again, everything is from China, but you can't put all your eggs in one basket. We looked at last year. I said the same thing. It worked varying degrees of success depending on where you got out. But Moneyline, for anyone who followed that ended up being a great play. That was one of my best winners last year. So, but this year now we're at a different point. At the beginning of last year, we had Tesla at 100, right? We had everything just got smashed, and then we ended up having that great rally of January the 1st. But this year, we're coming off we're at an all-time high virtually for the NASDAQ and the S&P. All these companies, when Microsoft last year was probably in the 200s, is now almost 400. All these tech stocks at all-time highs. NVIDIA was in the 130s, 150s. It's now 550. So there's nothing I can concretely say this year that I'll go, right, this is my number one pick. The only thing that seems good value is China, but China's been a dog for years. So I don't know how long it's going to take before that suppression stops. And then, coming to that, but Tesla, it's another one that obviously had the great rally. So if you look at it year on year, it's performed very well. But relative to the latest rally that we had, we saw that S&P just go through the roof. Tesla didn't really partake in that rally. And so, obviously China's part of the story because of the immense competition there. But what else do you see?
Yeah, well, obviously these price cuts, this is what is kind of really leading to these margin concerns, because it's essentially kind of destroying shareholder value every time they reduce prices. But obviously Tesla say they have real-time pricing data, and they understand their markets, and they keep on dropping it. Obviously their mission is to try to get as many cars on the road as possible that are electrically powered, but yeah, the thing is, it's not great look for investors. Also, these shipping issues in the Middle East, and then the potential war that's going to go on there is causing supply chain issues that's affected their European plant in Germany. It's causing a 2-week shutdown there, and I think that it's not actually that bad, because Tesla have already ramped up production, and they have I think 60,000 units available to kind of buffer anyway. So they've got that overproduction so it's not going to be a big issue there, but it's just the fears really. And also in terms of the messaging from Tesla as well, with its last earnings call, it wasn't very optimistic. So unless we see Elon really come out and really try to push a positive narrative for the company, investors aren't going to be hugely optimistic. And you can always see what's happening on Twitter with the Tesla bulls, right? When Tesla stock is going up, everyone's happy. Tesla can do no wrong. And if you just go to Tesla Twitter now, or Tesla X, whatever they call it, you just see this infighting with these bulls, and one would just say something slightly critical of Tesla, and then everyone attacks, and it just seems like there's just whenever Tesla stock goes down, there's just so much negativity that but I think one thing that came up yesterday is someone posted a thread on the Tesla board should be incentivized to kind of give Elon a new pay package to incentivize him to kind of take Tesla's valuation to say 10 trillion. And Elon replied, that would be nice. So maybe he's looking for something, because, you know, if you look at what Elon's doing right now, he's playing games. It doesn't seem like he's like hugely motivated, even though I'm sure he's doing a lot of work behind the scenes anyway. But just his persona on Twitter is just a lot more political things, etc., etc., etc. So the thing is, I would say the main risks that I see for Tesla are the institutions aren't feeling to put in a huge amount of money on Tesla. I mean, if you look at institutional ownership of Tesla, I think it was something like around 54%, whilst like Microsoft is like 78%, right? So like, you know, it's only when the big money comes in does it really move the stock so much. And so the main things are kind of, you know, like the key man risk with Elon, you know, valuation risk as well, with, you know, the high PE, and is it justified in earnings? That's the main thing, and we'll all find out what's going to happen over the next few quarters. But mainly in this earnings call, I really hope that they're a bit more optimistic and, you know, try to excite investors again.
Yeah, I mean, you know, it's funny when you talk about Tesla Twitter or X, is because there's such a big retail following, right? The emotions we feel with any stock, right, just gets played out on the public sphere in Tesla. So like, you know, I felt the same with my like terrible nat gas positions or some of my China positions, but I'm just talking to myself about it, you know, going through my, you know, own demons in my head. Whereas with Tesla, it's just everybody, no one sees things through a clear lens, because when you are so tied to the stock, you get emotional and you can't see clearly what is happening. And so what happens is that everybody feels like if everyone is optimistic, that's going to somehow influence the share price. You know, it just doesn't work like that. Like sometimes the hardest thing to do when you trade is to just think totally clearly and don't have your own biases cloud what is actually happening. And so this is the situation. So everyone has their long-term view, everyone has their view and everything like that. But what happens when people get too attached to it, and then you start getting emotional when someone says something that is affecting your cash, you know? I mean, you see it with Bitcoin, like everybody was, I mean, Bitcoin, that's another thing that's just gone bananas. But then as soon as this announcement happened, like talking about buy the rumor, sell the fact, it was so obvious. Like it was just, everybody, like I could have told this from a mile away the moment it got announced that it was going to all sell off, you know, and now you're going to probably have that ramp up in Ethereum, which is already happening on the back of that one. Just rinse and repeat, you know, if that's going to get approved, and get ready to sell it as soon as it get approved. And but again, it's weird with this crypto, just quickly digressing to that, is that every bull run there's been a proper catalyst, but this run there hasn't been a proper catalyst other than this ETF approval. Like I haven't seen any like talk of this is the new, you know, before it was Web3, before that it was DeFi, and then, but what is it this year apart from ETF, you know? I don't know. I'm not an expert, but it's crazy how much has moved up, but in a way it's been good because I've been able to, just like the stocks, get out some junk, you know, lighten the load a little bit. But then again, I'm not a long-term believer in a lot of the shitty coins, but you know, this is what it is. But yes, I mean, so looking ahead, so what do you see coming for the year up?
I think we've seen quite a lot of layoffs recently, with Citigroup laying off 20,000 staff. You know, we've seen Google, we've seen Amazon, Audible as well, and, you know, many other companies. So it really depends, like how much of this job market is really going to be infected, and how much does that convince the Fed to aggressively cut or not. That's the main thing. I mean, if we're looking at a inflation rate of, like, say, between 3 and 4%, then do interest rates really need to be at 5? You know, they can come down to 4, right? Potentially. So yeah, I mean, obviously that would give the market legs. Who knows if things are going to go wild like they were back in 2020, 2021. But I do see there's going to be some of these crazy meme rallies that come along, maybe for certain segments, you know, whilst the market is on the uptrend. But yeah, the main risk is, are we going to hit a recessionary environment? And, you know, we've seen quite a few prominent ex-users like Puru talk about how we're never going to be able to escape a stock market fall if we hit a recession, and, you know, lowering rates. So I mean, yeah, what do you think?
Again, these little meme rallies, like some of the moves we had in like Mara, Coinbase, and you know, I beg we get loads of those, because those are the short opportunities on these parabolic moves. As long as you time it correctly, have just been golden. I think opportunities. And remember, when you're trading, you're always like, the easiest way to trade is to fade the excess, right? So when you get this outdone move to the downside for no real, you know, if there's a massively, like if there's a drug company that, you know, failed a phase 3 trial, okay, that's different. But you know, if it's just some hype move up or hype move down and there's no real fundamentals behind it, that fading those hype moves are like probably the most profitable plays right now. And so I'm hoping that we do just, all you want as a trader, and especially for those who follow the Money Discourse trade log, is you just want volatility. The more volatility you get, the better positions you can put on. You can go a bit further out, increase your probability of profit. And so this is the main thing that I just hope that we get. Like the one thing I don't want is just a drab market that just trickles upwards or trickles downwards. Like that is the worst trading environment. So for me, as always, I just want a good trading environment. I'm not too fussed really what happens, but if we get a decent trading environment, then, you know, you got to just play what you see, right? So again, I just want to plug the Money Discourse, hold on a second, the Twitter page. So for those that don't subscribe or don't follow, it'd be good to join in here. You know, we have all the trades that have been put up. We put it up, and then you know, some of the earnings. And what I'm going to try to do is try to do a few breakdowns of, you know, I was meant to do it last year, but just never got around to it. But like, you know, if there's some good earnings, just do a few deep dives on them. So just give a bit more in-depth detail into what happened in the quarter, especially given that earnings are coming up. And because this is Q4 and it's spread up over a longer time, it's a bit easier to write them because there ain't so many. So yeah, so this has everything, some of the movers that are all happening. And so yeah, it's, well, you know, like you know, we follow a lot of the same sort of, you know, there's a lot of stuff out there, but I think this is pretty good, even if we're the ones doing it. But it's definitely worth checking out. And yeah, so if you're not subscribed, and also you know, take a look at the Money Discourse trade log. It's purely for entertainment purposes only, right? It's not a solicitation to buy or sell or anything, but you know, this is always done just with a base portfolio of 10,000. So since we started now, we're up 7,000, almost 7,800. So that's a 78% return on it, all using just safe strategy. So last year was pretty good. It was a 46% return. So far in 2024, already up 5%. And again, it's just, you can see it's all, you know, there's a pretty high win rate. You know, it worked out as like 7 winners for every 3 losers, or 8 winners for every 2 losers. And it's all just low risk trades. And even if you lose, it's very easy to make it back up again. So right now we've got a position in Mobileye. Again, they had this huge, they pre-announced they had a huge decline. So again, sort of stepping in front and trying to fade it a little bit. You've got Exxon, which is obviously being affected by the oil prices, K-Web, Baba. So that's my 2 exposures to China. So although I want to do Baidu as well tomorrow, I already got 2 positions on China. So I don't know if it's really worth getting into that too, but we'll see what the volatility is like. Oh, I forgot I got JD as well. So I got 3 Chinese positions. So yeah, so finally with Mara, that's one of the other positions we've got. That's been hit lately on the back of this Bitcoin and the crypto move down. But so I expect that position to be coming off tomorrow. It was quite a good move, went from 31 down to 19, so an almost 50% move downwards, which is another perfect example of why, you know, you just fade the hype, because that was a definite hype stock. But yeah, so feel free to subscribe. Yeah, and Jason, any parting words?
Yeah, Rajan, just thanks again, man. You know, like, just imagine having someone take you around the world. Look at that gain, 78%. I'm telling you, look, anyone, hedge funds, what, just need to hire this guy. 78%. Come on, man. You know, you can't get better.
It's easy to get 78% on it. Well, it's not easy, but the thing is now, again, it's just the main thing is it's just been trading for a long time, and sometimes it takes you a long time to figure it out. It's just money management. The key to trading is money management. Now, most people, as we all know, want to make money quickly. So they'll over leverage to get that big gain. And the thing is, if it doesn't work out, you get blown out. But if you risk 1, 2, 3, 4, 5, but depending on your account size, no more than 5% per trade, you can survive any bad trade. And that's just the number one key. So like, even when you go through a bad spell, you can make it back up. But like, if you look at my normal portfolio and some of the declines I've got on some of the crap that I have, I'm down 90%. I ain't recovering that back up. You know, it's just the way it goes, and you lose them. That's why I like the options, because if you define the risk, even if you, let's just say, hypothetically, you know, like I was long Mobileye, and it went $10 past my long put, you know, I'm not going to lose more than my defined risk. And so that's, for me, judging, because I get very tied to a stock and I don't stick to my stop losses the way I should, this strategy works for me. But some people might be better at doing other things. And for some people, this type of thing just takes too long. It's not exciting enough. It's not a razzmatazz. It's not going to take you to the Rio quickly enough. You're not going to get rich quick. And so if that is the type of trader you are, this is not what you want to follow. So this is just how it works out, you know. So
yeah. Well, hope you enjoyed our first 2024 episode. And yeah, we'll see you guys in the next one.
Yeah, we'll catch you on the next one.